This is Richard Flax at MoneyFarm with our regular monthly update. There's a lot to discuss this month. We'll spend a little time reviewing financial markets in February, and then talk about the ongoing crisis in the Middle East and its impact on financial markets. In a lot of ways, February continued the trends that we'd seen over the previous few months. Financial markets generally rose, with commodities and equities outperforming bonds. Within equities, the US stock market continued to lag, while European and emerging market equities outperformed. Within the tech space, we continue to see investors prefer tech hardware, memory producers and semiconductor manufacturers. There's still a lot of uncertainty on the outlook for software businesses, as investors remain concerned that developments in artificial intelligence could significantly disrupt those businesses. On the fixed income side, in February we saw bond yields generally fall, with the UK 10-year yield dropping by around 30 basis points. That helped support a decent return for fixed income ETFs in February. It's also important for the Chancellor, who's looking for ways to free up cash. Lowering the cost of debt is a good way to do that, provided you can sustain it. And it allowed the Chancellor to increase her fiscal headroom in the latest spring statement. In terms of key questions for this month, the most relevant questions came just at the end of February. What is happening in the Middle East? And what will the impact be on financial markets and portfolios? Last weekend, Israel and the US aircraft attacked Iran. Iran responded with attacks against US, Israel, and a number of its neighbors in the Middle East. It's impossible to know how long the conflict will last or how wide the impact will be. While we're hoping for a swift and peaceful resolution to the conflict, we're also focused on the implications for client portfolios. In general, after the markets reopened after the weekend, we saw oil and natural gas prices rise sharply, the dollar strengthened, and risky assets like equities were generally weaker. It was also interesting to see that government bond yields rose, given concerns that higher energy prices could feed into inflation. Around 20% of global oil and gas goes through the Straits of Hormuz, and shipping in the region is currently heavily impacted. As we think about our portfolios, there are a few points to make. First, recent history suggests that we shouldn't be too quick to act during periods of geopolitical crisis. Markets have generally rebounded quite quickly, and a long-term focus has generally paid dividends. Second, we think that portfolios are generally well diversified across countries, sectors, and asset classes. And third, we think we're fairly conservatively positioned, and that we could use market weakness to add to some of our positions. There are some caveats. The longer the conflict continues, the greater the potential impact on the global economy, particularly if energy costs stay high. And it's tough to know how long this conflict will last. Concerns about higher inflation can impact longer-dated government bond yields, and we've already seen yields rise. That means longer-dated government bonds might not be a great source of diversification. We generally prefer shorter-dated government bonds, and recently reduced some of our long-dated government bonds in some portfolios. We've also seen that US equities so far have held up better than some of their global peers. That's partly thanks to a stronger dollar, but it's also a reminder that the US is relatively more energy independent than many of its European peers. So for now, we'll stay focused on the long term while assessing the risks and opportunities in a volatile market. Thanks for listening, and look forward to speaking to you again soon.